The $100,000 tax mistake 99% of seniors make with inherited IRAs. You saved for decades, but one IRS rule can quietly shrink your kid's inheritance by $100,000 or more. Most non-spouse heirs now have to empty inherited traditional IRAs within 10 years, and the taxes can spike fast. The painful part is it looks harmless until year 10. Here's what you'll learn today: how the 10-year rule really works, why let it sit backfires, and the exact playbook to lower taxes legally. I'll give you real numbers, simple timelines, and choices you can make this year, like Roth Conversions, smart beneficiary designations, and bracket-filling withdrawals. Let's expose the rule that trips up almost everyone. The problem: how the 10-year rule really works. Most people heard that the stretch IRA died, but they don't know what replaced it. The Secure Act took away lifetime stretch distributions for most non-spouse beneficiaries and replaced them with a hard deadline: empty the inherited IRA by December 31 of the 10th year after death. If you inherit in 2025, the account must be at zero by the end of 2035. That one sentence changes everything for your family's taxes. Now here's the part most folks miss. For many beneficiaries, there's no required minimum distribution in years 1 through 9. The IRS doesn't care how you pace withdrawals during the decade, they care that the balance is fully distributed by year 10. Sounds flexible, right? It is, but that flexibility is a trap if you don't plan. Because when people wait, market growth swells the account, then a giant year 10 withdrawal collides with the heir's regular income and blasts them into higher tax brackets. There's another layer. If the original IRA owner died after they'd already started RMDs, current IRS regulations require many non-spouse beneficiaries to take annual RMDs in years 1 through 9 and still empty the account by year 10. So you can have forced withdrawals every year plus a final cleanout. Miss those required amounts and you're looking at a penalty on the shortfall. The point is, the 10-year clock runs either way, and the schedule might not be optional. Why does this matter so much? Because inherited IRA distributions are ordinary income to the heir. They stack on top of their salary, bonuses, side income, everything. If your adult children are in their peak earning years, adding tens of thousands from an inheritance can push them into higher marginal rates. That's the obvious hit. The hidden hits are just as costly. Higher adjusted gross income can trigger Medicare IRMAA surcharges, increase how much of their Social Security is taxable, phase out deductions and credits, and even trip the net investment income tax for higher earners. State taxes pile on too, and some states tax IRA distributions at full rates. Let me make the timeline crystal clear. The 10-year period starts the year after death. You can take nothing in year 1, something in year 2, more in year 6. It's your choice unless those annual RMDs apply due to the original owner's RMD status. But the deadline does not move. On December 31 of year 10, the account must be zero. Brokers won't always warn you midstream, and the IRS won't send a reminder. This is one of those no one tells you until it's too late rules. Who doesn't get stuck with this 10-year squeeze? A small group called eligible designated beneficiaries. A surviving spouse, a minor child of the decedent until they reach majority, a beneficiary who is disabled or chronically ill, and someone no more than 10 years younger than the decedent. Spouses often can do a rollover and use lifetime RMDs. Minor children can stretch only until they reach majority, then the 10-year rule kicks in. Most adult children. They're non-eligible and on the 10-year clock. Trusts add complexity. If a trust is the beneficiary, the type of trust matters. A conduit trust generally passes out the RMDs to the individual and may follow beneficiary rules. An accumulation trust can trap income inside the trust, which often means higher trust tax rates on undistributed income. That's not automatically bad, but it needs to be drafted and coordinated carefully. And naming the estate as beneficiary often creates probate delays and can accelerate taxes with fewer options for pacing distributions. That's a paperwork mistake with real dollar costs. Here's a common scenario. Parent dies with a $600,000 traditional IRA. 2 adult kids inherit 50-50, they both make solid incomes. They figure, let's let it grow and deal with it later. Markets cooperate, and by year 10 their shares are larger. Then they each face a big distribution in a year they're already maxed out at work. Their marginal rates jump, their AGI spikes. One trips IRMAA 2 years later, both lose deductions they were counting on. If the parent died after RMD age, they also had required withdrawals each year, which they didn't plan for, so they either underwithheld or scrambled at tax time. The reason the rule hurts is simple. You lose control of timing if you ignore it. Taxes are about timing. If you don't choose when income shows up, the law chooses for you, usually in the worst possible year. The 10-year rule gives you a window, but it's a shrinking window with a hard wall at the end. Using that window intentionally is the difference between a minor tax bump and a six-figure mistake. So the problem isn't just the rule, it's how families react to it. The let-it-sit instinct made sense when stretch IRAs existed. Now it concentrates income in fewer years and higher brackets. In a minute, I'll show you why waiting backfires mathematically and how a simple bracket-filling plan can flip the outcome. Why let-it-sit backfires, the math of bracket creep. Most people think, if I don't touch it, it grows and that's good. For investments, that's often true. For inherited traditional IRAs under the 10-year rule, growth without withdrawals can be a tax trap. The problem isn't growth. It's when that growth converts into taxable income stacked on top of a high-earning year. That stack is what pushes heirs into higher brackets, triggers Medicare surcharges later, and quietly erases a big chunk of the inheritance. Let me show you how the math sneaks up on people. Say your adult child inherits $500,000 in a traditional IRA. If markets average roughly 4% to 5% after fees, that can be $700,000 plus by year 10. Sounds great until they have to empty it. A $700,000 distribution in one calendar year is ordinary income. If they're already earning well, that one move drives them into top brackets for that year, sets off deduction phase-outs, and can create estimated tax penalties if they don't plan withholding. Now here's where most people mess up. They think, I'll just spread withdrawals evenly, 10 years, 10 equal payments. It feels disciplined, but equal payments can still be worse than a bracket plan. Why? Because your income and brackets aren't flat. Heirs have peak earning years, bonus years, sabbaticals, parental leave, job changes, and retirement dates. If you don't match withdrawals to low-income windows, you end up taking money in years when every extra dollar is taxed at a higher marginal rate. The thing most people miss is inflation's role. Brackets adjust, but your account might compound faster than brackets rise. If the account grows at 5% and brackets move 2% to 3%, the tax pain increases over time. So waiting skews more of the dollars into later years when the balance, and thus the required cleanout, is bigger. That's bracket creep in action. The tax system nudges you into higher marginal slices without a dramatic change in lifestyle. This clicked for me when I saw two siblings do it differently. One took small withdrawals every year, but not randomly. She filled her 22% bracket each year and stopped. The other waited until year 9 and then tried to spread it over years 9 and 10 to get it over with. The patient, bracket-filling approach paid thousands less in tax overall, even though she withdrew more in earlier years. The reason this works is simple. You're swapping uncertain future high rates for known lower rates now. Let me show you exactly how to think about it. First, map the heir's projected income for the next 10 years. Salary, bonuses, stock vesting, business swings, planned retirement. Identify lower income windows, maybe a sabbatical in year 3 or retirement in year 7. Those are the slots to pull more from the inherited IRA. In the high-income years, take little or nothing if you're not required to. In low-income years, intentionally fill up to the top of a target bracket. Common mistakes to avoid. Taking nothing for 8 years and then discovering required annual withdrawals apply because the decedent died after their RMD age. Underwithholding and getting hit with penalties. Forgetting that inherited IRA withdrawals can affect things like the 3.8% net investment income tax if they lift modified AGI above thresholds, and ignoring state taxes, which can be brutal in high-tax states. A quick example: your child earns $180,000 today and expects to retire in year 6. If they wait until year 10, they might face a massive distribution while still working, or they'll have only a short window to drain it post-retirement, forcing big withdrawals in years 6 through 10. Better plan: take modest withdrawals in years 1 through 5 to the top of a chosen bracket, then larger withdrawals in years 6 through 8 when earned income drops, leaving a smaller balance for years 9 and 10. Same 10-year window, very different tax result. The game changer nobody talks about is coordinating with other moving parts. If your heir is exercising stock options or selling a rental property in a given year, that's not the year to pile on IRA income. If they're contributing heavily to pre-tax 401(k)s, that might create room to pull more from the inherited IRA without crossing into the next bracket. And if they're close to Medicare later in the decade, keep in mind IRMAA looks at 2-year-old income, so year 8 withdrawals can raise year 10 Medicare premiums. Here's the shortcut nobody teaches. Set a ceiling each year. For example, we'll take inherited IRA withdrawals up to the top of the 22% bracket, no higher. Automate quarterly estimates or increase withholding on those distributions to avoid penalties. Revisit in Q3 with a tax projection and adjust in Q4. That rhythm keeps you from drifting into a year 10 pileup. If you remember nothing else, remember this: the 10-year flexibility is fake if you don't plan. Letting it sit concentrates income in the worst years. Filling brackets, timing around life events, and adjusting annually turns that same rule into an advantage. Core principle: control timing, control taxes. Taxes are a timing problem dressed up as paperwork. The 10-year rule doesn't force you to pay more tax, it punishes you if you let the income arrive at the wrong time. So the core move is simple: choose when the income hits your return. When you control timing, you control the rate. When you control the rate, you control the cost. Why does this matter? Because marginal rates are what drain inheritances, not average rates. If dollars show up during a peak income year, they're taxed at the top slice. Spread those same dollars into lower income years and you buy them back at a discount. That's real money, not theory, especially when the balance compounds while you wait. Here's the technique stated plainly. Adopt a bracket-filling mindset. Pick a target bracket, say the top of 12% or 22%, and take only enough inherited IRA distributions to fill that ceiling each year. Don't spill into the next bracket unless you're doing it on purpose. This shifts the reflex from avoid any tax now to pay the lowest known rate now so I don't pay a higher unknown rate later. Let me show you exactly how. Step 1. Map your next 10 years. List salary, bonuses, equity vesting, rental income, expected business swings, and any planned breaks, sabbatical, part-time work, retirement. Step 2. Overlay tax brackets and key cliffs, IRMAA thresholds, NIIT thresholds, and state bracket jumps. Step 3. For each year, set a ceiling. Example, we'll go up to the top of the 22% bracket, but not over the NIIT threshold. Step 4. Pace withdrawals to fill up to that ceiling using withholding or quarterly estimates to avoid penalties. Step 5. Revisit each fall with a tax projection and adjust the final pull in Q4. Now here's where most people mess up. They chase the market instead of the bracket. They withdraw more when stocks rise and less when stocks fall. That sounds intuitive, but it's backwards. Investments live inside the account, taxes live on your return. You can rebalance inside the inherited IRA anytime. The withdrawal amount should follow your tax plan, not the S&P 500. Coordinate timing with your own retirement milestones. If you're the original owner, your pre-RMD years. The gap years after you stop working but before Social Security and RMDs start are the sweetest spot for Roth conversions. Converting in those years fills low brackets while you control the rate. That doesn't eliminate the 10-year rule for heirs, but it changes the game. Heirs inherit Roth assets they can withdraw tax-free within 10 years, avoiding the spike to their ordinary rates. If you're the heir, the same logic applies with distributions, not conversions. Use low-income windows aggressively. Planning a career change in year 3, pull more that year, retiring in year 6. Front-load withdrawals in years 6 through 8. Hitting Medicare at 65. Remember, IRMAA looks back 2 years, so big pulls at 63 can raise premiums at 65. You don't need to memorize rules, just note the cliffs and avoid crossing them accidentally. The thing most people miss is stacking effects. A well-timed $25,000 withdrawal might land in a 12% bracket with no collateral damage. The same $25,000 in a different year might push you into 24%, trigger NIIT on investment income, and raise future Medicare premiums. Same dollar amount, radically different bill. That's why timing beats investment returns in this decision. Quick win you can do this week: run a rough tax projection for the current year. Find the top of your target bracket. If there's room, take a partial distribution now and withhold at your marginal rate. Put a Q3 reminder on your calendar to rerun the numbers and top up in Q4. That rhythm alone prevents year 10 pileups. If you remember nothing else, remember this: don't let the deadline choose your tax rate. Decide your ceiling, spread the income, coordinate with life events. When you control timing, you control taxes. And when you control taxes, you protect 6 figures of family wealth without taking more investment risk. Beneficiary types: who gets exceptions, who doesn't. Before we build the plan, we need to know who actually has to follow the 10-year rule and who gets a different path. The Secure Act draws a hard line between most beneficiaries and a small group with exceptions. If you get this wrong on your forms, everything else is harder and more expensive. Start with the special group called eligible designated beneficiaries. There are 5 of them. 1, a surviving spouse. 2, a minor child of the person who died, not grandchildren, specifically the decedent's minor child. 3, someone who's disabled. 4, someone who's chronically ill. And 5, an individual who's not more than 10 years younger than the decedent, think an older sibling or a long-time partner close in age. Why does this status matter? Because most EDBs aren't stuck with the strict 10-year deadline immediately. Spouses often get the most flexibility. They can keep the account as an inherited IRA and use life expectancy payouts, or they can do a spousal rollover and treat it as their own IRA, which means delaying and using lifetime RMDs based on their age. That usually lowers annual income and keeps brackets in check. For a minor child of the decedent, the stretch lasts only until they reach the age of majority in their state. After that, a fresh 10-year clock starts, and the account must still be emptied by the end of that period. Disabled and chronically ill beneficiaries can generally use lifetime distributions tied to their life expectancy, and the not more than 10 years younger beneficiary can also use life expectancy payouts. Now here's where most families land. Adult children and grandchildren are not EDBs. They are non-eligible designated beneficiaries, and the 10-year rule applies. That means the entire inherited traditional IRA must be fully distributed by December 31 of the 10th year after death. Depending on whether the original owner had started RMDs, they may also have to take annual required distributions in years 1 through 9. Either way, year 10 is a hard stop. Before we continue, you need to understand how designations drive these outcomes. A clear, up-to-date beneficiary form is the key. If an individual is named, they're a designated beneficiary and can at least use the 10-year window. If no individual is named and the estate becomes the default beneficiary, you often lose the 10-year flexibility, face probate delays, and may be stuck with much less favorable payout rules. That's a paperwork error that can cost real money. Trusts raise the stakes. Naming a trust as beneficiary can be smart for control or protection, but it has to be drafted right. A conduit trust typically passes out the required distributions each year to the trust beneficiary, essentially mirroring the beneficiary's rules. If the decedent died after starting RMDs, the trust may have to distribute annually and still empty by year 10. An accumulation trust lets the trustee retain withdrawals inside the trust. That can protect assets, but undistributed income inside a trust hits top tax brackets at very low dollar amounts. Translation: strong control, potentially steep taxes if income stays inside. If you go the trust route, coordinate the draft language with the 10-year framework and confirm how income will flow. Here's the shortcut nobody teaches: match the beneficiary type to the goal. If flexibility and lower taxes matter most for a spouse, a rollover to their own IRA often wins. If a child has special needs, EDB status supports life expectancy payouts. Pair that with a properly drafted trust to protect benefits. If your heirs are adult children in peak earnings, assume the 10-year rule applies and build the plan around bracket filling, Roth conversions during your lifetime, and precise withholding. One more nuance: multiple beneficiaries on one account don't share one rule blindly. Each beneficiary's status applies to their share. Splitting the account by beneficiary after death lets each person follow their own timeline. That's why naming multiple beneficiaries directly rather than funneling everything through your estate is usually cleaner. Bottom line, know which side of the line your heirs fall on, design the beneficiary form to match, and draft any trusts with the 10-year rule in mind. Get the players right first, then the strategies snap into place. Strategy 1: Roth conversions while you control the bracket. If control timing, control taxes is the principle, Roth conversions are how you exercise that control while you're alive. Converting shifts dollars from pre-tax to Roth and creates tax-free withdrawals later for you and your heirs. It's not magic, it's a trade. You voluntarily recognize income now at a rate you choose so your family doesn't get slammed later at rates you can't control. The best window is when your income dips. For many retirees, that's the gap years, after you stop working and before Social Security and RMDs start. Those years often have the most headroom in the 12%, 22%, or 24% brackets. That's prime territory for bracket filling conversions. Convert up to a ceiling you set, no more. Don't let a conversion spill you into a higher bracket unless you've modeled it and it still wins. Here's why this helps your heirs. Traditional IRAs force ordinary income on them in that 10-year window. A Roth doesn't. Yes, the 10-year clock still applies for non-spouse heirs, but distributions are tax-free if the Roth is seasoned. That removes the bracket spike and the collateral damage to credits, IRMAA, and NIIT. You're prepaying the tax at a controlled rate so they don't pay at a higher, messy rate later. Let me show you exactly how to implement this. Step 1. Map your income for the next 5 to 10 years, pensions, part-time work, dividends, when Social Security starts and when RMDs begin. Step 2. Pick a conversion ceiling. Common ceilings: the top of 12% if your living costs are low, the top of 22% or 24% if your heirs are likely in higher brackets. Step 3. Convert in chunks each year up to that ceiling. Step 4. Coordinate with Healthcare Affordable Care Act subsidies and Medicare IRMAA thresholds can change the math. Step 5. Use withholding on the conversion or quarterly estimates to avoid penalties. Now here's where most people mess up. They convert too much in one year because the market dipped and it felt cheap. Markets don't determine your tax rate, brackets do. Overshooting one year can push you into higher brackets, trigger NIIT, or set up IRMAA surcharges 2 years later. Another mistake: using IRA withholding to pay the conversion tax when you're under 59.5. That can count as a taxable distribution and in some cases create penalties. Better pay taxes from cash or a taxable account so the full converted amount lands in the Roth. The thing most people miss is coordination across programs. If you're pre-Medicare and buying coverage on the ACA marketplace, a large conversion might shrink or eliminate premium tax credits. That doesn't mean skip the conversion, it means model the total cost. After 65, IRMAA surcharges look back 2 years at your modified AGI. A sizable conversion at 63 can raise Medicare premiums at 65. Sometimes that's still worth it, just make it a conscious choice. Let's talk targets. A lot of people aim to fill the top of the 12% bracket first, then consider the 22% or 24% bracket if heirs are in 32%, 35%, or 37%. If you think tax rates will rise in the future or your heirs will be in high brackets, paying 22% or 24% now can be a discount. If you plan heavy charitable giving via QCDs later, you might convert less because QCDs can reduce future RMDs without raising your AGI. Quick win you can do this week: run a projection for this year. Find your current taxable income and the gap to your target bracket top. That gap is your conversion capacity. Set a conversion in 2 tranches, one now with 22% or 24% federal withholding from a taxable account, and a Q4 true-up after you see your final income. Put a Q3 reminder to recheck IRMAA and NIIT thresholds before you finalize. Common questions: can your kids convert the inherited traditional IRA to a Roth? Non-spouse beneficiaries generally can't convert inherited IRAs. That door closes when you die. That's why converting during your lifetime is the lever. What about converting everything at once? Rarely optimal. Spreading conversions lets you manage brackets, IRMAA, and ACA impacts year by year while markets move. A micro story. A couple retired at 64 with a $1.2 million traditional IRA. They delayed Social Security to 70. For 5 years, they converted to the top of the 22% bracket, then paused when Medicare began to avoid IRMAA spikes. By 70, half their IRA was Roth. When they passed, their children still had a 10-year clock, but the Roth portion created zero tax. Compared to no conversions, the family saved well into 6 figures over the decade. If you remember nothing else, remember this: choose your tax rate on purpose. Use your low-income years to convert methodically. Coordinate with healthcare thresholds, fund the tax from outside the IRA, and set an annual ceiling you won't exceed. Do that, and you erase the worst of the 10-year spike for your heirs while giving yourself flexible, tax-free dollars for the rest of your life. Strategy 2: Beneficiary designations that reduce the tax spike. Roth conversions are powerful, but your beneficiary form is the switchboard. A crisp designation can spread the 10-year burden, route taxable dollars to lower brackets, and avoid traps that force ugly taxes. The form is short, the consequences are not. Let's make it work for you. Start with a simple rule: match the asset to the heir's tax profile. Pre-tax IRAs create ordinary income. If one child is a nurse earning $85,000 and another is a software executive earning $350,000, don't split the traditional IRA 50-50 by default. consider sending more of the traditional IRA to the lower earner and more of the Roth or taxable assets to the higher earner. You're not favoring one child, you're allocating after-tax value so both end up closer to equal in real dollars. Naming multiple beneficiaries helps by dividing the 10-year problem. If two heirs inherit separate shares, each can tailor their own withdrawal schedule, hit their own ceilings, and avoid sinking mistakes. After death, make sure the custodian splits the account into separate inherited IRAs by beneficiary as soon as possible. One account with two names forces coordination. Two accounts with two names unlock flexibility. Now, don't mix tax profiles without intent. If you name a trust and 3 children on the same IRA, you can end up with administrative delay and uneven rules. Keep pre-tax IRAs clean. Name the exact people or the specific trust you truly need. Use your Roth and taxable accounts to balance the rest of the plan. Remember, taxable accounts get a step up in basis at death. Roth IRAs pay out tax-free. Traditional IRAs are fully taxable. Use that hierarchy to your advantage. Charitable intent changes the math. If you plan to give a portion of your estate, put charities in line to receive pre-tax IRA dollars. Qualified charities don't pay income tax, so every dollar from your traditional IRA lands tax-free with them. Then leave Roth or step-up assets to family. That one move often increases the net amount your heirs and your causes receive. No complex trust required. Speaking of trusts, you need to be precise. Conduit trusts can force out required amounts annually to the beneficiary and typically avoid trapping income inside the trust at high trust brackets. Accumulation trusts allow the trustee to retain income for protection, but undistributed income inside a trust hits top tax rates quickly. If you use a trust for control, blended families, spendthrift concerns, special needs, get counsel that understands the Secure Act rules and drafts for the 10-year framework. The cheapest boilerplate trust can be the most expensive tax decision you make. One pitfall to avoid: naming your estate as beneficiary. That often means probate delays, loss of designated beneficiary status, and potentially faster payout rules depending on the decedent's age. It also invites creditors and reduces your heirs' options. Fix it now. Name people or a properly drafted trust, not your estate. Keep designations current. Life changes, marriage, divorce, births, deaths don't update your form by magic. Make a habit, review beneficiaries every other year and after any major event. Confirm legal names, percentages, primary and contingent beneficiaries, and how per stirps or per capita should apply in your family. Contingents matter. If a primary predeceases you and there's no contingent, you can default to the estate without realizing it. Age and timing matter too. If one heir plans to retire in 3 years and another is a decade away, consider tilting more pre-tax IRA to the near retiree who will have lower income windows sooner. If one heir lives in a high-tax state and another in a no-tax state, tilt pre-tax to the no-tax resident and Roth/taxable to the high-tax resident. That's a quiet way to raise after-tax inheritance without changing headline percentages. Here's a simple framework you can use this week. Step 1. List each account by tax type: traditional IRA, Roth IRA, taxable. Step 2. List each heir's current bracket, state, and expected income changes over 10 years. Step 3. Decide your intent: equal after-tax results or fixed percentages regardless of tax. Step 4. Align account types to heirs based on brackets, state, and timing. Step 5. Execute clean beneficiary forms with primaries and contingents, then document your reasoning in a short letter so your executor understands the plan. Common mistakes: using 1/3 to each child across every account instead of assigning by tax type, forgetting contingents, leaving an old ex-spouse on an account, naming a trust without confirming conduit versus accumulation mechanics, and assuming the custodian's default rules match your wishes. They often don't. If you remember nothing else, remember this: your beneficiary form is a tax plan. Split the 10-year burden by person, not by habit. Send pre-tax assets where they'll face the lowest rates, use Roth and taxable to balance, keep forms current, and only use trusts on purpose and drafted right. That's how you cut the spike before it ever hits your heirs' returns. Strategy 3. Qualified charitable distributions, QCDs, and charitable tools. If you're already giving to charity, QCDs are the cleanest way to turn generosity into a tax tool. Once you're 70.5, you can send money directly from your IRA to a qualified charity and it never hits your adjusted gross income. It can also count toward your RMD once you reach RMD age. That's the magic. you satisfy the IRS and keep your AGI lower at the same time. Why does that matter? Because AGI is the trigger for so many hidden costs. Lower AGI can help you avoid Medicare IRMAA surcharges 2 years later, keep more of your Social Security from being taxable, avoid deduction phaseouts, and dodge thresholds like the net investment income tax. A check written from your checking account doesn't do that. Only a QCD keeps the donation out of income in the first place. Here's the technique in plain English. If you're 70 or older, ask your IRA custodian to send funds directly to a 501(c)(3) charity. You can do this even if you don't itemize deductions. If you're already taking RMDs, QCDs applied first reduce or satisfy the RMD dollar for dollar without inflating income. That sequence matters. Don't take your RMD and then try to do a QCD. Once you pull money into taxable income, you can't unring the bell. Lead with QCDs, then pull any remaining RMD if needed. How much? The annual QCD limit is indexed for inflation, and the point isn't the ceiling, it's the rhythm. Set an annual giving plan and automate it through your custodian each year. Batch larger QCDs early in the year if you want to lock in the AGI benefit and simplify withholding. Keep the acknowledgement letters from the charities. You'll need them for your records even though it's not an itemized deduction. Common mistakes to avoid. Sending the money to yourself and then to the charity, that's not a QCD. Using donor-advised funds for QCDs. QCDs can't go to DAFs, private foundations, or supporting organizations. Forgetting to notify the charity that the check came from your IRA custodian, ask them to confirm receipt and note it as a QCD. And failing to coordinate with withholding. Since QCDs aren't taxable, don't withhold from them. If you want to give but also like the idea of batching, pair QCDs with a donor-advised fund for your non-IRA assets. Here's how it works. Use QCDs from the IRA to keep AGI low and shrink the pre-tax balance over time. Separately, if you have appreciated stock in a taxable account, donate shares to a DAF to avoid capital gains and claim a deduction when it helps. You get the AGI benefit from the QCD and the deduction benefit from appreciated assets, 2 levers, different accounts. Now, what if you love the idea of income to an heir plus a charitable legacy? Consider charitable remainder trusts as a dedicated tool. You can name a CRT as the beneficiary of a traditional IRA. At death, the IRA pours into the CRT without immediate income tax. The trust then pays your chosen beneficiary a stream of income for life or a term of years, and whatever's left goes to charity. This doesn't eliminate tax forever. The distributions carry out taxable income to the beneficiary, but it can stretch payments beyond the 10-year window, smooth the tax hit, and protect assets. It's paperwork heavy and needs good drafting, so it's not a casual move, but it's a solid option if you want control and charity in the mix. Here's a quick decision lens. If you already give annually and want the simplest tax cut, QCDs starting now at 70.5 before you take any RMDs each year. If you want a bunch bigger gifts for planning reasons, use a DAF with appreciated taxable assets, not your IRA, and keep doing QCDs for AGI control. If your goals include income to a loved one plus a guaranteed charitable remainder, explore a CRT as your IRA beneficiary and model the cash flows and taxes. A micro story. A 75-year-old with a $2 million traditional IRA gave $40,000 a year to charities. She switched to QCDs for the full amount. Her RMD shrank by that $40,000 on paper. Her AGI stayed lower. She avoided an IRMAA tier, and over time her IRA balance dropped, reducing the future 10-year burden for her kids. Same generosity, far better math. If you remember nothing else, remember this: QCDs first, then any remaining RMD. Keep AGI low, shrink the pre-tax IRA while you're alive, and use other charitable tools, DAFs and CRTs, only where they fit your goals. Strategy 4. Life insurance as a tax smoothing tool. Sometimes the cleanest way to beat the 10-year spike is to turn taxable dollars into tax-free dollars while you're alive. You didn't save for decades, so the IRS could inherit your legacy. That's what life insurance can do when it's funded by planned IRA withdrawals. You're not dodging tax. You're paying it on purpose at a rate you choose, then leaving an income tax-free death benefit that your heirs can use however they need, without pushing them into higher brackets. Here's the idea in plain English. You take structured withdrawals from your traditional IRA each year, ideally in your low brackets or during gap years, to fund premiums on a permanent policy like whole life or guaranteed universal life. Those premiums buy a death benefit that pays out income tax-free to your beneficiaries. You've essentially prepaid the tax at your rate and converted what would have been ordinary income to tax-free cash. That's a smoother, more predictable result than forcing your kids to drain a large IRA in 10 years. When does this work best? 3 conditions help. 1. Your IRA is large enough that your heirs would likely face high brackets under the 10-year rule. 2. Your health and age make permanent coverage reasonably priced. And 3. You don't need every IRA dollar for living expenses. If those fit, insurance can be a powerful lever. If not, stick with Roth Conversions, QCDs, and smart distributions. Now let me show you exactly how to evaluate it. Start with a tax-aware withdrawal plan. How much can you pull each year without crossing your target bracket or IRMAA thresholds? That annual amount becomes your premium budget. Next, get quotes for permanent policies that fit that budget. Look at guaranteed death benefit designs if the main goal is legacy, not cash value. Ask for the guaranteed and current assumptions side by side so you see the floor, not just the rosy projection. The thing most people miss is the after-tax internal rate of return. Compare what your heirs might net if you kept the IRA intact versus what they receive as a tax-free death benefit after you've paid tax on plan withdrawals. If your heirs are likely in 32%, 37% federal brackets, plus state, the insurance can be competitive or better because it removes the 10-year compression and the AGI side effects. If your heirs are in very low brackets, insurance may not pencil as well. Do the math, not the myth. Consider ownership, too. If estate taxes could be a factor, an irrevocable life insurance trust can own the policy so the death benefit stays outside your taxable estate. That adds complexity but can preserve more for heirs. If estate tax isn't a concern, personal ownership is simpler and usually fine. Either way, name beneficiaries clearly and keep the policy in good standing. Missed premiums can sink the whole plan. Common pitfalls to avoid: overpaying for cash value when you really need guaranteed death benefit, underfunding a flexible premium policy and watching the guarantees lapse in later years, buying a policy without stress testing future premiums against your tax ceiling, ignoring coordination with Roth Conversions. Often the best plan is a blend: modest conversions plus right-sized insurance, not an all-or-nothing bet. Here's a quick decision lens you can use this week. 1. Set your annual tax-safe withdrawal amount from the IRA. 2. Request 2 insurance designs at that budget: a guaranteed universal life focused on death benefit and a well-structured whole life with reduced paid-up options. 3. Stack these against a do-nothing path where heirs drain the IRA in 10 years at their projected bracket. 4. Compare net to heirs and risk. Which path delivers more after-tax value with fewer surprises? A micro story. A 68-year-old with a $1 million traditional IRA and 2 high-earning children had limited Roth capacity without hitting IRMAA. He pulled $40,000 a year from the IRA within the 22% bracket and funded a guaranteed universal life policy with a level premium. He paid tax at known rates. The $1 million death benefit passed income tax-free. His kids still had to empty the remaining IRA within 10 years, but the insurance gave them flexible cash to cover those taxes or skip distributions in bad income years. If you remember nothing else, remember this: life insurance can prepay tax at your chosen rate and hand your heirs tax-free dollars on their schedule. Size the policy to your bracket, stress test premiums, and blend it with conversions and QCDs. Done right, it turns a forced 10-year tax problem into a controlled legacy. Heirs Playbook: Smart 10-Year Distribution Schedules. Let's turn this into a plan you can actually follow. The goal isn't perfection, it's avoiding a year 10 pileup and using low tax windows on purpose. Here's a simple schedule that works for most non-spouse heirs with tweaks for your income and life events. Start with a 2-month setup. In the first 60 days, open a separate inherited IRA in your name and verify whether the decedent died after starting their own RMDs. That detail determines if you owe annual RMDs in years 1 through 9. Next, gather your income picture: salary, bonuses, equity vesting, rental income, business swings. Pull last year's return and your current pay stubs. Then do a quick projection for this year to find the top of your target bracket. Years 0 through 2 are about assessing and setting a schedule. Don't drift. If you're working at a high salary, you might take minimal distributions early, unless annual RMDs apply. If you have flexibility, start with a modest bracket fill to the top of your chosen bracket. Set withholding on each distribution to your marginal rate so you don't owe surprises. If the decedent died after RMD age and annual RMDs apply, take them early each year and withhold appropriately. Put reminders on your calendar for Q3 projections and a Q4 true-up. Now choose your pacing style. Even distributions sound safe, but bracket filling usually wins. Even pacing is 10 equal withdrawals, fine if your income is flat and mid-range. Bracket filling means you set a ceiling, say the top of the 22% bracket, and take only enough to reach it each year. Market-aware withdrawals are the third option. You still follow bracket ceilings, but you rebalance inside the account and sell what's up to fund the distribution. This keeps your tax plan steady while managing investment risk. Coordinate with life events. If you know a sabbatical, parental leave, or career pivot is coming in year 3, plan larger withdrawals that year. If you expect to retire in year 6, do minimal distributions while working and then front-load in year 6 through 8 when earned income drops. If you're selling a property or exercising stock options in a given year, pull less or nothing if you're not required to. The point is to avoid stacking big taxable events in the same calendar year. Withholding matters more than people think. Under-withholding can trigger penalties even if you pay by April. Solve it in 2 ways. Set a default withholding percentage on each inherited IRA distribution that matches your marginal rate, and top up with a Q4 catch-up withdrawal with higher withholding if your Q3 projection shows a shortfall. Many custodians allow you to adjust withholding per distribution. Use that flexibility to stay penalty safe. Quarterly estimates are a clean alternative if you prefer to control cash flow. If you go this route, schedule automatic quarterly payments based on your bracket fill plan. Then, in September, rerun your numbers and adjust the final quarter. Keep it boring and consistent. Boring beats panic in year 10. Use tax loss harvesting in high-income years to offset capital gains in your taxable account while you're taking larger inherited IRA withdrawals. It won't offset IRA income directly, but it keeps your overall tax bill lower. In years you fill higher brackets intentionally, pair distributions with larger charitable gifts, donate appreciated securities from taxable accounts, and keep QCDs in mind if you're 70 and a half or older. Here's a sample timeline to copy. Years 1 through 2, confirm RMD status, set bracket ceiling, take minimal or ceiling level withdrawals with proper withholding. Years 3 through 5, if income dips or you take a leave, increase distributions to shrink the balance. Years 6 through 8, retirement window, front-load withdrawals aggressively to reduce what's left. Years 9 and 10, mop up the remainder. Keep a spreadsheet running with an end-of-October checkpoint to confirm you're on pace to hit 0 by December 31 of year 10. Common mistakes to avoid: taking nothing until year 9, forgetting to split a shared inherited IRA into separate accounts per beneficiary, ignoring state tax differences when deciding which spouse carries more income in a given year, and letting the market dictate withdrawal size instead of your tax ceiling. Another big one: copying a sibling's plan. Your income, state, and benefits are different. Your schedule should be too. If you're close to Medicare, watch the 2-year look-back for IRMAA. Big withdrawals at 63 can raise premiums at 65, often by roughly $200 to $400 per month depending on the tier, or about $2,400 to $4,800 per year. Sometimes that's fine, just plan around it. If you're using ACA marketplace coverage, keep an eye on premium tax credit cliffs. Large withdrawals can shrink or eliminate subsidies. Again, this doesn't mean don't withdraw, it means withdraw intentionally. Finally, get it in writing. Draft a 1-page plan, your bracket ceiling, required annual RMDs if applicable, target distribution windows by year, withholding method and calendar checkpoints, Q3 projections and Q4 true-ups. Share it with your tax pro and the sibling or spouse who's helping. The plan will change, that's the point. You'll adapt each year and avoid the year 10 cliff. Your quick win today: run a current year projection, find your ceiling, and schedule 1 distribution this month with correct withholding. Then put a Q3 reminder on your calendar to revisit. That simple rhythm turns a messy decade into a manageable checklist. Common mistakes: what most families get wrong. Don't do what most families do and wait until year 9. Procrastination turns flexibility into a crisis. The 10-year window looks generous, so people take nothing, let the balance grow, and then discover they owe annual RMDs because the decedent died after starting theirs and they still must empty the account by year 10. That's 2 problems at once: forced withdrawals plus a shrinking timeline. Fix it early, confirm RMD status in month 1 and set a bracket ceiling in month 2. In high-tax states like California, the stakes are even higher. Stack a 37% top federal bracket with up to 13.3% state tax, and you're looking at 50% plus combined rates on inherited IRA withdrawals in the wrong year. One poorly timed 6-figure distribution can send half the money to taxes. Timing isn't optional, it's the difference between keeping dollars in the family or handing them to the state and federal government. Naming the estate or the wrong trust is another silent killer. When no individual beneficiary is named, you can lose the 10-year flexibility, get stuck in probate, and face payout rules tied to the decedent's age. With the wrong trust type, income can pile up inside the trust and hit top trust tax rates at low levels. If you need a trust, draft a conduit trust when possible for tax flow-through, or use an accumulation trust only with clear reasons and funding rules. Best fix: keep beneficiary forms clean and current with primaries and contingents. Failing to update beneficiaries after a divorce, remarriage, birth, or death causes heartbreaking outcomes. Custodians follow forms, not wills. An ex-spouse left on an IRA means the ex gets the money. A predeceased child with no contingent named can force assets to your estate. Build a repeatable habit. Every other year and after any major life event, review every account's beneficiary form: traditional IRA, Roth, employer plans, annuities, legal names, percentages per stirps or per capita, and contingents. Roth conversions without IRMAA planning surprise a lot of retirees. A big conversion at 63 can raise Medicare premiums at 65 because of the 2-year look-back. That doesn't mean skip conversions, it means size them. Set a conversion ceiling that stays below the IRMAA breakpoints you care about, and know which tiers you're willing to cross. Sometimes paying a modest surcharge is still worth it if it removes a 6-figure tax hit from your heirs. Do it eyes open. Another mistake: letting markets dictate your withdrawal schedule. People sell more when stocks are up and less when they're down. Taxes don't care about the S&P rebalance inside the Inherited IRA. Set distributions by your tax plan. Pair that with proper withholding. Under-withholding triggers estimated tax penalties even if you settle up in April. Solve it with per-distribution withholding at your marginal rate and a Q4 catch-up if your Q3 projection shows a gap. Heirs often forget state taxes entirely. Moving from a high-tax to a no-tax state mid-decade changes the playbook. If a relocation is on the horizon, time larger withdrawals for the low-tax years. Families with multiple heirs in different states should tilt pre-tax IRA shares toward lower tax residents and offset with more Roth or taxable assets for higher tax residents. Equal headlines are not equal outcomes. Think in after-tax dollars. Missing the QCD first sequence wastes easy savings. If you're 70 a half or older and charitably inclined, QCDs reduce RMDs and keep AGI lower. Taking the RMD first and then trying a QCD later doesn't work. The income already hit your return. Lead with QCDs, then pull any remainder. Keep your acknowledgement letters, the IRS won't guess. Trusting custodian defaults is another trap. Default withholding might be too low, distribution options may not split promptly among beneficiaries, and helpful tools can assume even pacing instead of your bracket plan. Drive the process. Request separate inherited IRAs by beneficiary, set custom withholding, and schedule distributions tied to your ceiling, not the platform's template. Finally, copying a sibling's plan rarely works. Different salaries, stock vesting, states, ages, Medicare timing, your paths diverge quickly. Coordinate so you don't both take large withdrawals in the same calendar year for family events that spike AGI, but personalize your bracket ceilings and timelines. Here's your correction list. Verify RMD status, update every beneficiary form, set a bracket ceiling, choose QCDs first if eligible, size conversions around IRMAA, withhold correctly, time withdrawals to your tax plan, and tailor schedules per heir. Small fixes, big difference over 10 years. Case studies before and after tax outcomes. Let's make this real with numbers. I'll keep it simple and focus on the decisions that move the tax bill the most. Case 1, a single retiree with a $1 million traditional IRA and 2 working children. No planning first. Parent dies at 78, already taking RMDs. Each child inherits $500,000 and must take annual RMDs in years 1 through 9 and empty by year 10. They wait, markets grow 4% annually, and each balance reaches roughly $650,000 by year 10. One child earns $220,000, the other $180,000. In year 10, each pulls about $400,000 to finish. Result, both spike into higher brackets, trip the 3.8% NIIT due to elevated magi, and lose deductions. Over the decade, family tax outlay is heavy and lumpy. Now the same family with staged Roth conversions. From ages 66 to 70, the retiree converts $150,000 a year to the top of the 22% bracket, paying taxes from a taxable account. About $600,000 lands in Roth, $400,000 remains pre-tax. When death occurs at 78, the kids inherit a mix, half Roth, half traditional. The Roth side must still be emptied by year 10, but it's tax-free. The traditional side is smaller, so bracket-filling distributions over the decade fit under their 24% ceilings most years. Net result, the family shifts tax from unknown higher rates in the kids' peak years to known lower rates earlier. The after-tax difference for the heirs is well into six figures. Case 2, married couple, large RMDs, strong charitable intent. They're 75 with a $2 million traditional IRA and give $50,000 a year to charity. No planning first. They take the full RMD, write checks to charity, itemize, but AGI stays high. That raises the chance of IRMAA surcharges and inflates taxes on Social Security. When they pass, non-spouse heirs face the 10-year rule on a still large IRA. Now switch to QCDs and beneficiary shifts. They direct $50,000 annually from their IRA straight to qualified charities as QCDs. That reduces AGI and counts toward RMDs. Over time, the IRA shrinks faster without AGI spikes, keeping them under key IRMAA tiers. On their beneficiary forms, they name a charitable organization for 20% of the remaining traditional IRA and leave Roth and taxable assets to family. The charity pays no income tax on its share. The heirs receive a smaller pre-tax burden and more tax-free or step-up assets. Same generosity, better cash flow, and a smaller 10-year problem for the kids. Case 3, moderate IRA with two very different heirs. Parent has a $600,000 traditional IRA and wants equal outcomes. Child A earns $350,000 in a high-tax state. Child B earns $80,000 in a no-tax state. The straight 50-50 split looks fair, but after tax it's not. Better move, tilt the pre-tax IRA heavier to Child B and compensate Child A with a larger share of Roth or taxable assets. After death, the custodian splits into separate inherited IRAs immediately. Child A uses minimal annual withdrawals and fills only to a 24% ceiling, relying more on the Roth and taxable assets. Child B takes larger bracket-filling withdrawals across the decade, still staying under NIIT thresholds. The family evens the after-tax inheritance without changing the headline percentages on paper. Case 4, trust named by default, then corrected. Parent's IRA names the estate because no beneficiary form was filed. Probate delays, payout options narrow, and flexibility is lost. The fix while alive: execute updated beneficiary designations naming individuals, and where control is needed, a properly drafted conduit trust for a minor or special needs heir. After death, each beneficiary's share follows their own 10-year path. The accumulation trust is used only where protection outweighs tax drag, and the trustee distributes strategically to keep trust income from hitting the highest trust brackets. Case 5, insurance as a tax smoother. A 68-year-old with a $1 million traditional IRA and two high-income children can convert only modestly without hitting IRMAA. He sets a tax-safe withdrawal of $40,000 per year within the 22% bracket and uses it to fund a guaranteed universal life policy sized for a $1 million death benefit. He pays tax now at known rates. The policy passes income tax-free. When he dies, the remaining IRA, now smaller, still faces the 10-year clock, but the heirs can use the tax-free proceeds to cover taxes or avoid withdrawals in their peak income years. Compared to no planning, the after-tax variability drops and the expected net to heirs rises. One more quick scenario. Adult child inherits $500,000 in 2025, plans to retire in 2031. The wait-then-dump approach means a large final withdrawal while still working. The bracket fill approach: small distributions years 1 through 5 to the top of a target bracket, big pools in years 6 and 7 after retirement, and mop up by year 10. Same window, lower average tax rate, fewer collateral hits like NIIT and IRMAA later. The teaching thread across all of these is simple: move income to lower rate years on purpose. Use QCDs to keep AGI low if you're giving anyway. Align account types to heirs based on their brackets and states. Use insurance only when it buys a better after-tax, lower volatility result, and get beneficiary forms exact so the plan actually happens. Timeline planner: what to do this year and next. Let's turn strategy into a simple calendar you can follow. The clock starts now. Every month you wait, you lose planning options. The goal is predictable moves you repeat every year with small tweaks when life changes. Start with this year. In the next 2 weeks, pull every account statement in your last tax return. Make a one-page inventory: traditional IRAs, Roth IRAs, employer plans, taxable accounts, beneficiary names, and percentages. Next, verify the Inherited IRA's rule set. Did the decedent die after starting RMDs? If yes, note that you may owe annual RMDs in years 1 through 9 and must still empty by year 10. Write the year 10 December 31 deadline at the top of the page. Now map your bracket. Take your expected income for this year, salary, bonuses, interest, dividends, rental income, and run a quick projection to find the top of your target bracket. Pick a ceiling, top of the 12%, 22%, or 24% bracket, adjusted for your situation and state taxes. Add cliffs beside it: NIIT thresholds, Medicare IRMAA thresholds, and any state bracket jumps. This becomes your guardrail. Set a conversion and distribution plan. If you're the original owner in low-income years, set a Roth Conversion ceiling to your chosen bracket. If you're an heir, set an Inherited IRA withdrawal ceiling to the same bracket. Choose withholding, either per distribution at your marginal rate or quarterly estimates. Put 2 dates on your calendar: a Q3 tax projection check in early September and a Q4 true-up in early December. RMD season has a clear order of operations. If you're 70 or older and you give to charity, do qualified charitable distributions first. Direct your IRA custodian to send the QCD to a qualified charity so it never hits your AGI. Then, if you still owe more for your RMD, take the remainder with proper withholding. Sequence matters: QCDs first, then any leftover RMD. Keep every acknowledgement letter from the charities. Set an annual cadence that's boring on purpose. In January, update your inventory and confirm beneficiaries are correct, primaries and contingents, legal names, percentages, and per stirps versus per capita. In March, run a first-pass projection and adjust retirement plan contributions to create more room under your bracket ceiling if needed. In June, rebalance investments inside accounts. Your withdrawal plan follows the tax ceiling, not the market. In September, do the Q3 projection and adjust your final distribution or conversion amount. In December, execute the true-up and confirm withholding covers your expected bill. When major life events hit, recalculate. Retirement date moved up. Lower income may open more room for withdrawals or conversions. Raise your ceiling if it stays under your IRMAA line. Starting Social Security, expect higher AGI. You may dial down conversions and focus on Inherited IRA withdrawals within your limit. Approaching Medicare, remember the 2-year look-back for IRMAA. Big moves at 63 show up at 65. Changing states. Time larger withdrawals for no-tax years when possible. Get your heirs ready. Write a simple letter of instructions, where the accounts are, who to call at each custodian, the 10-year deadline, whether annual RMDs apply, and your philosophy, bracket ceilings, withholding, and calendar checkpoints. Include a one-page 10-year schedule template with columns for year, projected income, ceiling, plan distribution, actual distribution, and running balance. Tell them to split inherited accounts immediately so each beneficiary can run their own plan. Integrate all accounts so you don't optimize one and hurt another. Use taxable accounts for charitable gifts of appreciated securities and for cash to pay conversion taxes. Preserve Roth for last when possible and house higher growth assets there. Keep income-heavy holdings in tax-deferred accounts to control current year AGI. When you need cash, pick the account that keeps you under your ceiling this year and preserves optionality for next year. Watch penalties. If you're using estimates, schedule automatic payments in April, June, September, and January. If you're using withholding, remember withholding is treated as if paid evenly through the year. One smart fix is a late year distribution with higher withholding to erase an underpayment. Put a penalty check on your Q3 list. Your quick win today: pick a ceiling, schedule one planned distribution or conversion with correct withholding, and put those 2 reminders, Q3 projection and Q4 true-up, on your calendar. Small, repeatable steps beat heroic year 10 rescues every time. Coordinating across account types: IRA, Roth, taxable. You've built the schedule. Now make the accounts work together so every dollar does the right job. Think of it as 3 buckets with different tax personalities: taxable, tax-deferred, traditional IRA/401k, and tax-free Roth. The order you pull from and what you store in each bucket changes your bill more than most people realize. Start with roles. Taxable is your flexible cash machine and your charitable engine. Traditional IRA is your ordinary income firehose, powerful, but it spikes AGI when you open it. Roth is your surgical tool, tax-free, no AGI impact, great for unexpected costs or high-income years. When you plan distributions for the 10-year rule, use each for what it's best at. Asset location matters. Put growthier, tax-inefficient assets in Roth where compounding is tax-free, small caps, high expected return funds, even higher turnover strategies if that's your style. Keep income-heavy assets, taxable bonds, REITs, high yield, inside tax-deferred to shield current income until you choose to recognize it. Hold tax-efficient equity index funds and municipal bonds in taxable. This mix lowers ongoing AGI so you can spend your AGI budget on inherited IRA withdrawals without tripping thresholds. Sequence withdrawals with your bracket ceiling, not a rigid rule. In lower income years, prioritize inherited IRA distributions up to your ceiling. That shrinks the 10-year problem while prices are low. If markets are down, rebalance inside accounts to avoid selling depressed assets to fund the distribution. In higher income years, big bonus, property sale, option exercise, lean on Roth for cash needs, so those dollars don't add to AGI while you keep inherited IRA pulls minimal or just to satisfy any annual RMD. Use taxable for taxes. Paying Roth conversion taxes or underwithholding from a taxable account preserves more pre-tax dollars to convert and more Roth dollars to grow. If you need liquidity, raise cash in taxable by selling lots with the smallest gains or harvest losses to offset gains. That keeps room under NIIT thresholds when the inherited IRA is already raising magi. Charitable strategy splits across accounts. Use QCDs from traditional IRAs at 70 plus to keep AGI down and count toward RMDs. Use appreciated securities from taxable for larger gifts or donor-advised funds, wipe out capital gains and get a deduction when it helps. Don't send Roth to charity, it's already tax-free and more valuable for heirs. Now here's where most people mess up. They tap Roth first because it feels good to pay no tax today. That often backfires. Early Roth spending removes your most valuable future tool, tax-free flexibility in high-income or high IRMAA years. Better spend taxable first, especially high basis or loss positions, then use tax-deferred or Roth based on your bracket plan. Preserve Roth for last resort or for plan spikes. Coordinate rebalancing with withdrawals. If your plan calls for a $30,000 inherited IRA distribution, raise it by selling what's overweight inside that IRA. Then use contributions or sales in taxable and Roth to restore your targets. Keep the tax plan and the investment plan in sync so you don't add taxable trades on top of taxable income without a reason. Mind wash sales. If you tax loss harvest in taxable, avoid buying a substantially identical fund in your IRA or Roth within 30 days before or after. A wash sale inside the IRA disallows the loss and you don't get basis credit back. Use slightly different tickers or wait the window to protect the deduction. Integrate spouse and state differences. If one of you works in a high-tax state and the other doesn't, or one spouse is near an IRMAA cliff, shift the inherited IRA distributions to the lower tax spouse where possible and offset household needs from the other buckets. If you plan to move to a no-tax state, take minimum distributions now and front-load after the move. Same decade, lower total tax. Your quick checklist. Assign asset locations deliberately, spend taxable first and smart, fill brackets with inherited IRA, protect Roth for flexibility, pair QCDs with appreciated stock gifts, avoid wash sales, and rebalance through your withdrawals. When the buckets play their parts, your 10-year plan gets easier and cheaper. Quick recap: the one-page playbook. Here's your one-page plan you can print and stick in a folder. First, control timing. Move income into lower rate years on purpose. Avoid year 10 pileups by setting an annual bracket ceiling and withdrawing to that line, not past it. Markets don't set your tax bill, your ceiling does. Second, convert when your rate is likely lower than your heirs' rate. Use your gap years to run steady Roth conversions up to the top of the 12%, 22%, or 24% bracket. Pay the tax from taxable cash so every converted dollar lands in Roth. Watch ACA subsidies before 65 and IRMAA after 65. If a surcharge is worth it, cross that tier intentionally. Third, QCDs if you give anyway. At 70.5 and older, send IRA dollars straight to qualified charities first, then take any remaining RMD. That keeps AGI down and trims IRMAA risk, taxable Social Security, and phase-outs. For larger gifts, use appreciated stock to a donor-advised fund from taxable, not from your IRA. Fourth, precise beneficiary designations. Name people, not your estate. Add contingents. Match tax types to heirs, more pre-tax to lower earners or no-tax states, more Roth and taxable to high earners or high-tax states. Use trusts only when you need control or protection, and draft for the 10-year rule, conduit for flow-through, accumulation only with eyes open to trust tax brackets. Fifth, heirs set a schedule on day one. Open separate inherited IRAs per beneficiary, confirm whether annual RMDs apply, choose bracket ceilings and withhold correctly. Use a Q3 projection and a Q4 true-up every year. Coordinate withdrawals with life events, sabbaticals, retirements, option exercises, home sales. Don't stack big taxable events in the same year if you can spread them. Sixth, coordinate accounts. Asset location, growth in Roth, income in tax-deferred, tax-efficient assets in taxable. Spend taxable first in SMART, then fill brackets with inherited IRA and protect Roth for flexibility. Pair rebalancing with required withdrawals. Avoid wash sales when harvesting losses in taxable. Seventh, life insurance only when it smooths taxes better than alternatives. Size premiums to your tax-safe withdrawal amount, favor guaranteed death benefit designs if legacy is the goal, and compare after-tax internal rates of return versus the 10-year drain at your heirs' projected brackets. Consider an ILIT if estate tax could be a factor. Finally, lock the rhythm. Annual beneficiary review, bracket map with guardrails, planned conversions or distributions, Q3 projection, Q4 true-up, and RMD season with QCD first. Put it in writing. Small, steady moves beat last-minute rescues every time. If you remember one thing, remember this. Choose when income hits your return so your heirs aren't forced to drain a growing IRA in 10 rushed, expensive years. Want the worksheet and calculators to set your bracket ceiling, QCD schedule, and 10-year plan in under an hour? Watch the companion video linked next, then subscribe for the advanced strategies on trusts, IRMAA tier planning, and state tax moves. Share this with the person who will inherit your accounts and set your first Q3 projection reminder today.